The flash crash was definitely the event that I can look back on that crystallized my fears and anxieties around what high-frequency trading was doing to the market. That day, I was on the trading desk, and basically we saw the market just disappear. It vanished, and it made me think maybe what we were doing wasn't good for the market, wasn't improving the market, wasn't making it more efficient. All the arguments that you hear about tighter spreads and lower volatility and higher liquidity, my experiences in financial services and in high-frequency trading told me that wasn't true. A lot of the claims about market quality are not accurate or misleading at best, and much of the research is produced by high-frequency trading groups.
One of the big arguments that's been made about the role of high-frequency traders in the flash crash and other market disruptions is that there's this loss of liquidity. They put so much liquidity into the market, and then in the first sign of trouble, they take it out. Is that one of the key things you saw that day?
Absolutely. We did what every other firm out there did. We pulled all of our orders. And that's what I mean when I said the market disappeared. It literally vanished. There were no offers to sell stock. There were no bids to buy stock for what must have been 30 seconds to a minute there. And when the market disappears, that's pure dysfunction. And it seemed to me that what we were doing was not making things more stable, it was making things more volatile. And when you look at studies of the flash crash, it shows definitively that high-frequency traders became net takers of liquidity. They were not providing liquidity, they were taking liquidity.
What are some of the most crazy predatory tactics that you think high-speed traders are still using right now?
So one of them is called quote stuffing, and it exploits a quality of the feeds that send data out of the exchanges. These feeds are broken up by alphabet. So you have, for example, A to C is one channel, and you can flood one of the symbols in that channel and slow down everybody who's listening to that feed, and then pick off people in another symbol within that same channel. I think it's better called a denial of service attack, much like hackers do, but they call it quote stuffing. That's a particularly egregious one, and in 2010 an academic study found pretty substantial evidence that that was occurring on a daily basis.
Do you think that's still occurring now? Has there been any success in cracking down on it?
None. I would say yes. Almost certainly that's still occurring.
And you can see it from some of the feeds?
Yes, you can see that. That study, for example, found something called co-movement of message flow in a channel. It's a mathematical term, but you would expect to see co-movement within an industry or symbols that are exposed to the same macroeconomic factors. But the fact that things were moving together because of their alphabetical listing makes no sense. The only explanation is nefarious activity. So if the market has ticked up, for example, and somebody still has stale orders in the market to sell at too low of a price, you can hit those orders and then sell at the next price level, and it's a riskless trade. And that's what they're looking for. They're looking for riskless trades. And most of the nefarious activity involves generating situations to realize these riskless trades.
It does seem like there is a technological arms race. You have to spend a certain amount of money to just be able to play in these financial markets, and if you don't, you're at a loss. What do you think that's done to the markets?
I think it's negatively affected the markets significantly. You see huge amounts of money, hundreds of millions of dollars, maybe billions of dollars over the last few years invested in technology to accelerate trading systems. And I'm a technologist. This is very strange for me to say. This was my business for a long time. But when you see metrics of market quality that have not been improving, then you have to question, what is this investment going to? And when you look at an industry and you say, maybe there are negative externalities being created here. Maybe this is a polluting industry, much like leather plants would pollute their water sources, and therefore they could make profits because society was bearing the cost of the pollution. That's a negative externality, that's the cost of which is not borne by the producer. And so therefore maybe high-frequency trading is making so much money because they are a polluting enterprise, and society is bearing the cost of that, and high frequency enjoys the benefits.